In this chapter, we're going to be talking about IAS 12, which is income tax. If you recall, when you did the financial statements, you did the statement of profit or loss and other comprehensive income, and near to the bottom you had, well, let's just quickly run through the general layout. Sales less cost of sales gave you gross profit. We added other income and we added other expenses. We then subtracted finance costs and we got profits before tax. And then we had income tax expense and we had a note to that. And that gave us profit for the year. Right, so in here we're going to have a note. And I said if you did FAC3661 with me, or the beginnings of your financial statements with me, then I would say don't give it note number 1, because note number 1 is your accounting policies. So run it a little bit further down, note number 4. Alright, then after profit for the year, you had other comprehensive income, and then you had total comprehensive income, and that was basically your statement. Alright, so income tax. We are going to be talking about how do we get to this amount, and what happens with other comprehensive income, and the tax effects thereof, and how do we calculate the tax, and how do we disclose the tax. Alright, so we're going to deal with a little bit of theory first, just to give you some background. Now the theory is going to be quite overwhelming. It's going to be a lot. In the beginning, once you've done a couple of examples and you go back to the theory, suddenly the theory will start making sense. Alright, so let's then have a look here. What does IAS 12 talk about? It prescribes the treatment for income tax. Okay, so it is inherent that in recognizing income tax, the asset or the liability section, or the liability that will be recovered, and this recovery and the settlement may give rise to future tax consequences, which needs to also be recognized as an asset or liability, and that is what we call deferred tax. All right, and we're going to deal with that in great detail. So for now, it's about recognizing the asset or the liability for income tax and future consequences in terms of tax, and that would be deferred tax. All right. The first important thing that you need to take note of, for now, you're going, okay, I'll come back and read this later, and then it'll make a little bit more sense. And otherwise, you know, as long as I know what it deals with, I can answer the theory question. But what we need to take note of at this point, in terms of our notes, is you need to account for the tax consequences of a transaction or any other events in the same way that it gets accounted for itself. So if you have got, for example, a profit or loss item occurring in that section, then the tax effects of that profit or loss item must be disclosed in this tax line. If you have an other comprehensive income item, then any tax effects would be disclosed in other comprehensive income section. If you have any tax effects like dividends, withholding tax, or anything like that in the statement of changes in equity, then you disclose the tax there. So wherever the income or expense is incurred or happens that causes a tax effect, wherever that is, the tax must be there. So if it's in the profit or loss section, the tax must be included in the profit or loss section. If it's in the other comprehensive income section, down here, oopsie, not there, here, then the tax effect of those transactions must be grouped with it. We don't deal with retained earnings, we only deal with profit or loss. Alright, so the other comprehensive income, you also don't deal with at third year level. Alright, so that's what that little sentence says, and that's just a basic idea of where we are going to with this. So there is a tax asset, in which case that means you're going to get a refund. There is a tax liability, which is usually the case, which means we're going to pay or owe SARS. Alright, so it meets the normal definition of an asset or a liability. So what is our basic concept? A tax asset is a refund. In other words, it's a future inflow, and it's the tax effect of those inflows. And a liability says I'm going to have to pay the tax later. So it's a future outflow. Alright, so just to quickly deal with the scope looks at tax based on taxable profits, whether it be foreign or domestic. It also looks at other taxes like dividend withholding tax. Okay, and we will deal with that. IAS does not deal with tax for government grants or investment tax credits. Okay, so that is not included in this scope of this module or this chapter for that matter. Right, here are some definitions. I'm not going to read them to you. You are going to read them all by yourself. Those definitions are there for you. If you are not understanding something, you can come back here and have a look at these definitions. All right, the summary of the general rules is we're going to have income tax expense on my statement of profit or loss, other comprehensive income, and it's going to consist of two components, current tax and deferred tax, and we're going to talk about those and tell you exactly what they are in a while. At the bottom of this page, I have given you some steps to account for deferred tax. There are 6 of those steps. I'm not going to run through those steps. You will then go and learn these steps and follow them when you work through an example. Okay, so basically they are now explained in detail in the rest of the notes, but you're going to determine the tax base of your assets and liabilities. You're going to identify temporary differences. You're going to determine what is exempt. You're going to measure the different taxes using inactive or substantively enacted tax rates. Okay, that's not really going to apply. You're just going to use your tax rates. You're going to recognize any deferred taxes and determine where to recognize the deferred tax, profit or loss, or other comprehensive income, or in equity itself. And as I said to you, we don't really do this at third year level. Alright, so you're going to look at how is this recovered and is it actually recovered. Then these steps are dealt with in detail. So determining your tax base, we're going to come back and have a look at this you're going to come back and have a look at this if you're still a little bit stuck on something, but it basically just gives you little layouts, little mind maps on if this, then that. Okay, what is the tax base of an asset? What is the tax base of a liability? It is actually very, very simple, but yes, what is the tax base of income received in advance or deferred income? Or you could, in this case, also look at a contract liability. All right, so we will deal with those later. Right, then identify any temporary differences, and as we work through the examples, you'll see it's a lot easier than it looks perhaps here. Then we're going to look at any exemptions. All right, we're going to look at initial recognition exemption. We're going to measure your current and deferred tax. The next step is to recognize your deferred tax. How much should we recognize in our financial statements? We're going to look at the current or deferred tax recognized in other components of other comprehensive income or equity. So that's not really for third year, but if you are doing this at CTA level, then obviously that will come up. Alright, so now those are your steps. I will come back to them and just add a few more details later. But let's just talk about some of the concepts that I've already mentioned to you that I've hopefully at least scared you into listening. Okay, so what are they going to ask us? So we're going to go back to those 6 steps later. What are they going to ask us in a question? They're going to ask us to disclose either the income tax note or the deferred tax note, or both, or do some calculations, and perhaps even a journal entry or 2. So those are the types of questions that are going to come up out of this chapter. So according to our IFRS, our standards, our conceptual framework and the accounting standards, we prepare our books based on the International Financial Reporting Standards, looking at your textbook, either this one or whatever your textbook looks like right now, but it's based on your IFRS. Now, when it comes to doing our income tax return, SARS is a different kettle of fish. SARS says, I'm like the special child. I do things my way. So that is your SICA handbook that tells you what is taxes and how does it work. And these two are not the same. My profit is not SARS's profit. Let me just give you a very, very simple thing that you're already aware of. We depreciate our assets whereas SARS allows for wear and tear. That is just one of the first and most obvious examples that we have dealt with. If you've done management accounting at second year, MAC 2602, you would have dealt with the tax repercussions that wear and tear is tax deductible, not our depreciation. All right, and the SARS has got guidelines for wear and tear. And just alone on that one little amount, there is going to be a difference between our accounting profit, so to speak. So I'm going to refer to this sometimes as our accounting profit, whereas SARS talks about our tax profit. All right, and because there's a difference, this is what we're going to refer to as deferred tax. So most of that is then timing differences, but we'll get to that in our examples. All right, so that is basically what deferred tax is. It is what is caused by the difference between our accounting profit and our SARS profit. What SARS allows as income and expenses as deductions, compared to what we deduct or add as income and expenses, the difference gives rise to deferred tax. Okay, and that's all you need to understand right now. On the next few pages, you're going to find some layouts that you can learn. The disclosure. How do we disclose the notes to the financial statements? So always, you've got the name of your company, notes to the financial statements for the year ended with the date. You can get marks for headings, so please make sure you put them in. So as I said to you, we're going to number it, let's say note number 4, income tax expense, and note number 5, deferred tax, which we will get to in a moment. And you're going to say we've got major components of income tax. What are the major components of income tax? We have got our normal current tax, and we have got deferred tax. And we are going to explain what goes under current tax and deferred tax. What are the temporary movements, the changes in tax rate, any tax losses carried forward. You will notice some of the blocks